Good morning. Hi, class. This is going to be a lesson where we're going to look at financial statements. And so I want to go over with you a problem that will be similar to your homework assignments, which is problem 1-2B. So I'm going to share my screen with you for just a second. I'm going to go straight to Cengage today. And you should be seeing problem 1-02B. This is a problem that's going to be similar to your homework assignments. And what we're going to learn about today is how to prepare financial statements. So I guess before we should start preparing our financial statements, I should say to you that all of the information that we've analyzed through the accounting equation through our business transactions, all of the information that we wrote down during this period of time would be summarized and reported in the form of financial statements. So in this problem, they give you amounts, but I want you to realize that the amounts actually come from those transactions that you analyzed all through the accounting period through the accounting equation. So you'll remember that when we were discussing in the last video how to analyze transactions through the accounting equation, you'll remember that we did each one of them separately, and then we combined all the amounts together at the end. And those ending balances are where these amounts would come from. So just want to make sure you understood where this information comes from. When we prepare financial statements, we're going to prepare them in an order. The reason that we prepare them in a certain order is because one financial statement will feed into the next financial statement. The very first financial statement that we always prepare for a company is the income statement. And on the income statement, you're going to find all the revenue that you've earned throughout the period and all the expenses that you've incurred throughout the period. Now on Cengage, you can see that they've started an income statement for you, and you're just going to fill in the blanks. But it's very important that you know how to prepare an income statement properly. And one of the first things that you will do when you're preparing an income statement, start with the heading. Notice the heading is the name of the company. It's got the name of the statement that you're preparing. In this case, we're preparing the income statement. And then it's got for the year ended April 30th, 2019. This is an income statement that's prepared for a whole year. That year ended on April the 30th. So it would have most likely started in the previous year on May the 1st. So it would have gone from May the 1st to April 30th for a whole year's worth of information. The date line is very important for your financial statements. This date line tells me that it's for a period of time. What we're going to be doing is measuring all of the revenue that we have during this period of time, and we're going to offset that revenue with the expenses that we've incurred all throughout this time period. When you start an income statement, you will start with the revenue accounts. So what we're going to do is we're going to look for in this information what our revenue would be. Our revenue is going to be fees earned. Our fees earned, as if you see something in green and you put your cursor over it, it'll tell you what that means. Our revenue is fees earned, it's revenue that we're getting from providing services. You should always read your information before you start the problem. So I'm going to backtrack a little bit and let's read the information about this problem so you'll know what the company is that we are generating these financial statements for. The amounts of assets, and notice they've got their definition: resources owned by a business, things of value that are owned by a business, and the liabilities, that's the rights of the creditors that represent the debts of the business, the amounts that you owe, in other words, of Wilderness Travel Service. That's going to be the name of our company. And the date is at April 30th, 2019, which is the end of the year. That tells us the accounting period. Accounting periods are periods of time where we measure data. So we're measuring the data for an entire year for this particular company. And we're going to record its revenues, which, let me move myself out of the way here. Revenues, which is increases in owner's equity as a result of selling services or products to a customer. In this case, we're a travel service, we're selling services, but revenues, the amount that you're going to charge the customer for the work that you performed within the business. That's what revenue means. And expenses are all of your assets that are used up while you are consuming, or while you are producing services. They are assets that are used up or are consumed in the process of generating revenues. So those are what expenses are. It also tells you the capital of Harper Borg, who is the owner, was $180,000 at May the 1st, 2018. May the 1st, 2018 was the beginning date for this accounting period. And this owner at that time was worth $180,000. So you may remember that when we were calculating owner's equity in the previous problem, we were doing it for a company that had not been in business for a while. This company has been in business for a while, so they have some beginning owner's equity that they're going to be starting with, and that beginning owner's equity is $180,000. That's at the beginning of the year. It also tells you that the owner is going to withdraw $40,000 during the year. So there's going to be some drawing or some withdrawals that we're going to have to account for when we are preparing our statement of owner's equity. But before we prepare any statements at all, the very first statement that we must prepare is the income statement. So on the income statement, what's important for you to know is what goes on the income statement. And we're going to list all of our revenue, and we're going to list all of our expenses. And so we always start an income statement with our revenue. You'll remember our revenue account was fees earned. That's what we're calling revenue here. Notice it's in green, and they're showing you the definition in green. If it's in green, the amount of the revenue that we have earned all throughout this period is $875,000. So we're going to put $875,000 in the box here. And then if you want to, check your work. It kind of jumps around, so you'll have to scroll back up to see what happened here. And you see we've got the green check marks, so we're in good shape. We're ready to go to the next part of the income statement. Always list your revenue first on the income statement. It's important the order that you put the lines of the income statement in, and we always start with our revenue first. Notice there are like two columns here, even though they're not showing basically as columns. You see how this is out to the side here of this box? I can see that there would be 2 columns to this. Fees earned goes into the furthest column out there because this is a total amount of revenue. Also on the income statement, you're going to have to list all of the expenses that you have incurred during this period of time. Now notice they made it kind of easy for us because they got a drop down list here. So I'm going to choose from this drop down list what my expenses are. Notice my expenses will have the term on them, expense. So wages expense is my first expense I'm going to write down. And my wages expense, if I go back up to the given information in the problem, my wages expense is $525,000. So you're simply going to write that amount in, and then you'll move to your next expense. Look through your list of accounts, pick out your expense. The next expense is rent expense in this list. Rent expense is $75,000. The next account is utilities expense. And utilities expense is $38,000. The next expense is supplies expense. Notice all of these accounts have expense on them, and accounts are places where we have recorded increases and decreases. When we analyzed all those business transactions, we ended up with supplies expense at the end of the period at $12,000. This represents all the supplies you used during that period of time. Taxes expense, $10,000. And then your last expense is miscellaneous expense. Miscellaneous expense will always go last in your list of expenses, and the amount of that is $15,000. And I'm going to check my work just to make sure I've put everything in correct. And so far, I've written in everything incorrect. And notice that your expenses go in order from highest down to lowest, with the exception of miscellaneous expense, which is always reported as the last account. Miscellaneous expense can consist of several really small expenses that we didn't want to take the time to open up an actual account for. And so this is a combination of several expenses, but expenses are recorded in their order, with the exception of miscellaneous. It's always reported last. On the income statement, it's very important that you total your expenses. Now on Cengage, they have a built-in calculator for you. I'm just going to click on this tab up here, and you can drag and move this calculator anywhere you want it to be. And so we're going to add up all of our expenses here. And if I've added all those correctly, the total is $675,000. And so that is the total of our expenses. Now on the income statement, the most important step is to determine whether or not you have what is called a net income for the year or whether you have a net loss for the year. To determine net income, we're going to compare the total of our revenue with the total of our expenses. Notice that our expenses for this company are less than the total of our revenue. And that's a good thing because you'll remember the total expenses decrease the owner's equity, but the total revenue add to the owner's equity. So what we're going to do is we're going to combine these two figures together. In other words, we're going to subtract the total of our expenses from the total of our fees earned. And because our fees earned is larger than our expenses, it will give us a net income. So I'm going to take my total revenue, $875,000, and I'm going to subtract from it $675,000, and that will give me my net income. My net income is $200,000. And I'm definitely going to check my work to make sure my net income is correct, because we're going to use this net income to help us to prepare the next statement. I would suggest you learn the statements one at a time. Learn the period of time that the statement is for. The income statement is for a period of time, and this period of time is for the year ended April 30th, 2019. When you report an income statement, you have to have a line that states that it is for the period of time that you're collecting the information for. So all of this information was collected during the year that ended on April 30th, 2019. The year would have started on May the 1st, 2018, and then we're going to go all the way for 12 months to the end of the period on April 30th, 2019. What this statement has told us is that we had more revenues than expenses, which is a good thing. Net income is good because net income will add to your owner's equity. So you have to remember the things that you've previously learned about owner's equity. It's very important. Remember, owner's investments increase owner's equity. The revenues will increase owner's equity. The expenses will decrease owner's equity. So what we really did is summarized our revenue and our expenses to determine that there was net income. Net income will add to our owner's equity. It increases owner's equity. If our expenses had been larger than our revenue, this name here would have become net loss. And net losses will decrease your owner's equity because the expenses which decrease owner's equity are larger than the revenue that will increase owner's equity. If you have a net loss, there will be a decrease in your total owner's equity. So to find net income, we compare the amount of the revenue to the amount of the expenses. If our revenue is larger than our expenses, we subtract and we will determine that we have net income. Net income adds to owner's equity. The second financial statement that you will prepare in a sole proprietorship form of business is what we refer to as the statement of owner's equity. And the statement of owner's equity is a summary of the changes in owner's equity that have occurred during the specific time period, such as a month or a year. The heading is what you start with on the statement of owner's equity. The heading consists of the name of the company, the name of the statement, and again, the accounting period of time that this statement is for. It's the same period of time as the income statement that we worked on before. When you are preparing a statement of owner's equity, always start with your beginning amount of owner's equity. Be careful here. Make sure you choose Harper Borg, which is the name of our owner, his capital account at the beginning of this period. The beginning of the period is May 1st, 2018. We want to know what that owner was worth at the beginning of the period. Since this was a company that had been in business for a while, you'll remember they told us that the owner had capital or his owner's equity at May 1st, 2018 was $180,000. That $180,000 is a given amount. Now, this beginning owner's equity really came from last year's ending owner's equity, or last year's ending capital is brought forward into this year as the beginning capital. Because when you start a business, you are assuming that you're going to be operating for life for a long period of time. So there are going to be more than one accounting period that you have been working on if you've been in business for more than one accounting period. So this information comes from the previous accounting period. It's just brought forward so that we have some information to start with on this statement of owner's equity. Now, remember the things that affect owner's equity that we've learned about when we are analyzing our transactions. Remember that the owner's investments will always increase the owner's equity. Look to see if there was an owner's investment during this period of time. And so I would look through my information to see if there was any owner's investment during this period of time. I don't see one. So let's see what we've got here. We don't have a choice of listing the owner's investment for this period of time. If you do have an owner's investment during this period of time, they would have told you in the additional information for this company. So there was no owner's investment during this period of time. But what we have already determined is that we know that our revenue will add to our owner's equity, and we know that our expenses will deduct from owner's equity. When we summarize those items in the income statement, we know that we have net income, and net income will add to our owner's equity. So when you're choosing from your list, we're going to pick up the net income for the year, and that is going to add to our owner's equity. The amount of the net income comes from the income statement. That's why we prepared it first, so we could feed this information into the statement of owner's equity. The things that affect owner's equity are the owner's investments, your revenue and expenses, which we combine together here, and also our withdrawals. Our withdrawals would come next on the statement of owner's equity, and we have to look for our withdrawals. Now, you could have had a drawing account, but I don't see one here. What they told us in the additional information was that the owner withdrew $40,000. So that's where I'm getting the $40,000 here that I'm going to enter into this box. The next thing you need to do is you need to compare your net income to the amount that the owners have taken out of the business for personal use. In other words, we're going to subtract our withdrawals from our net income. If the amount is positive, it will give us an increase in owner's equity. We're going to deduct $40,000 from the $200,000, and that will give us an increase in our owner's equity of $160,000. Now, the last step of the statement of owner's equity is to find the ending capital for the year. So we're going to choose the owner's name, capital, April 30th, which is our ending date, end of the year balance, and we're going to have to determine what our ending balance is. So we had a beginning balance of $180,000. I'm going to take that $180,000. I'm going to add to it, because this was an increase in owner's equity, $160,000. Try that again. $180,000 plus $160,000 will give me a total amount of ending owner's equity at $340,000. I would suggest you check your work often. You can check it as much as you want to. It's unlimited checks, so just check your work often, because you don't want to make a mistake in this, because if you do, it's going to affect the next statement that we have to do. This is a statement of owner's equity. Owner's equity statements usually give students trouble. Be careful with this statement and think about what you're doing. The beginning amount of owner's equity, which comes from the ending owner's equity for the last period, it just is brought forward, the beginning amount of owner's equity plus any additional investments, which there were none in this case. If there were, we would have wrote it right here underneath that beginning capital balance. And then we would have determined whether we had net income or a net loss, and we would have recorded it right here. If we had a net loss, this amount would become a negative. The withdrawals are taking owner's equity away from the owner, so this is always a negative. So if you had two negatives, a net loss and withdrawals, you would add the two negatives together, and that would give you a decrease in owner's equity. And that decrease in owner's equity would be subtracted from your beginning owner's equity to get your ending owner's equity. That's a what if analysis. Or what if your withdrawals, the owner took out more than the net income? This figure here could have been a negative or a decrease in owner's equity. If it were a decrease, we would subtract it from the beginning owner's equity to get what was left over. In this situation here, all was positive, all was good. The net income was a positive amount, which adds to owner's equity. We deducted our withdrawals because the owner took money out of the business. His equity went down. And overall, this period, there was an increase in owner's equity, which would be added to the beginning owner's equity to get the ending owner's equity. You can see that the owner has grown from 180,000 to 340,000. So it's always a good idea to kind of step back, look at your financial information to see what has happened during this period of time. The next financial statement that they want us to prepare is the balance sheet. And the balance sheet is just a restatement of the accounting equation. The balance sheet is a list of all the assets, liabilities, and owner's equity as of the last day of the accounting period. In this case, the accounting period was the year. This is the last day of the year. Notice on our heading, we record the name of the company, that it's the balance sheet that we're completing, and that the date is just for April 30th, 2019. The balance sheet shows us a picture of the company's financial conditions as of April 30th, 2019. These amounts that go on this balance sheet are only the ending balances of your accounts. So you remember when we analyzed all those transactions, we summarized them and found an ending balance at the end of the period of time. The balances of our assets, liabilities, and owner's equity will end up on the balance sheet as of the last day of the accounting period. That's the balances that we have left over in the asset or in the balance sheet accounts. They're always as of the ending date of the accounting period. So we start with assets because our accounting equation, you'll remember, was assets equal liabilities plus owner's equity. This balance sheet is in what we call report form, which means it's just going straight down the page. Sometimes balance sheets can be prepared where you would have the assets on the left side of the balance sheet. Then you would take the information for liabilities and put it on the right side of the balance sheet, and your owner's equity would also go over on the right side of the balance sheet. So there's different formats of the balance sheet. This one is what we call the report form because it's going straight down the page. List your assets first. Always your first asset is going to be cash. Put the ending balance in, which they have given you, 146,000. That comes from the summarized transactions for that period of time. That's the ending balance amount. That's the cash amount. Our other assets would be accounts receivable. Remember, all receivables are assets. Accounts receivable is where we are expecting to collect cash in the future from our customer. We sent the customer an invoice, but we haven't received the cash for the work that we've performed for that customer. That accounts receivable balance was $210,000. The next asset that we would list is our supplies account. Remember, supplies is a prepaid expense, and all prepaid expenses before they are used are recorded as assets. Our supplies has $9,000 in it. So supplies is 9,000. Notice this is not supplies expense. Your expenses are accounted for on your income statement, which we've already done. This is the unused portion of the supplies that you have left over at the end of the period. It's a good idea to check your work just to make sure you've copied everything in correctly here. And then we're going to total our assets. And again, I would check my work. The total of your assets, notice there's a double rule here. That stands for we're finished with our assets and the amount is correct to the best of our knowledge. This total of the assets has to balance with the total of our liabilities and our owner's equity at the end of the period. We're going to record our liabilities. The only liability we had was accounts payable. That liability at the end of the period had an amount of $25,000 that we owed to our creditors. And since there was only one liability, this is the total of the liabilities. For your owner's equity, they only want the ending owner's equity at April 30th, 2019. And that ending owner's equity comes from your statement of owner's equity. They want the capital account written here. We know it's for the last day of the period. The amount of that capital as of the last day of the period is $340,000. We bring it down and plug it here for the total of our ending owner's equity for this company. So the last thing that we do on the balance sheet is we combine the total of our liabilities plus the total of our owner's equity together. These two items are combined, and they have to, when you add these two together, they have to equal $365,000. That's how we know that our accounting equation is in balance and our balance sheet is reporting that we have balanced up all of our information for this period of time. When you add them together, it's $365,000, and that's the total of your liabilities and your owner's equity. So the total liabilities and owner's equity has to balance with the total of the assets. That's why they call this a balance sheet. A balance sheet is nothing more than your accounting equation at the end of the accounting period. So isn't it funny that when we analyze transactions, we start with the accounting equation and we end up with the accounting equation at the end of the period too. It's almost like we're coming full circle. Now in part 4, they're asking you what items appear on both the income statement and the statement of owner's equity. And they give you a drop-down list here. and out of this, which appear on both the income statement and the statement of owner's equity. Well, when we prepared our statement of owner's equity, we had to use the net income, didn't we? When we prepared our income statement, we had to determine the net income. So the net income is going to be found at the bottom of the income statement, and that net income is going to be fed into the statement of owner's equity. And the last question, and that was the last question. So these are 3 of the financial statements that you need to become very familiar with. We never get away from the information that we've talked about in Chapter 1. Learn everything you can about Chapter 1, because we're going to see it again in Chapter 2, and Chapter 3, and Chapter 4, and all the way through your accounting courses. This information is talked about over and over again. So why not learn it all in the beginning, and then that way you won't have to go back and try to relearn something. Learn how to analyze transactions through the accounting equation. Learn what your elements of the accounting equation are. Be able to give examples of the elements of the accounting equation. Be able to prepare your financial statements, the income statement, the statement of owner's equity, and the balance sheet. There's a 4th financial statement, which is the statement of cash flows. We'll talk about it a little bit in this chapter, but then we kind of get away from it for a long time until you hit one of the later chapters in accounting. In fact, we won't talk about it, but in Chapter 1 in this course, in another course, we really discussed what was called the cash flow statement. It too is a financial statement. They didn't ask us to prepare it here, but you're probably going to need to know some things about that statement, and we will discuss those in a later video. So this is all I want to talk to you about today. I'm going to stop sharing this with you, and send me an email if you got any questions at all about your homework. We'll see you next time. Bye-bye.